Welcome to another mortgage episode of Mortgage Masterminds. I'm Richard Greaser, VP of Marketing at Sales Boomerang, and my guest is Michael Sheneman, CFO of Bank 34. Michael, it's great to have you on.
Richard, thanks for having me. I'm happy to be here.
Quick plug on Sales Boomerang. If you don't know who we are, you've been living under a rock since 2017. Sales Boomerang notifies a lender the moment one of their borrowers needs a loan. One and two of the biggest lending companies in the country use Sales Boomerang to know before their borrower does when they could get a better loan. So if you don't know anything about Sales Boomerang, go to salesboomerang.com, check us out, and we'd love to have a call to learn more about you and your business. Now we might be able to help. Michael, let's jump right into this. Can you tell me a little bit about mortgage lending at Bank 34, and like what states do you operate in, and what does stand independent mean?
Yeah, so our business is really focused primarily in our two core markets of Arizona and New Mexico, and really when we say stand independent, we talk about supporting small businesses and local communities in the areas that we serve. So our economy has become so interconnected, and the financial services industry is so controlled by such a small number of companies. Being independent of that gives us the opportunity to serve our customers in unique ways and meet their needs in a way that a big box away from decision maker approach is unable to do. So that's really our focus, is serving those markets. We do have a couple of business lines that we lend nationally for, but our real core focus here is on the markets in Arizona and New Mexico. So, from a mortgage lending perspective, we don't have an enormous residential mortgage lending business. We do a lot of finance specifically around construction for merchant builders, spec builders, and kind of, I would say, small to mid-size developer home builders. And that's really kind of the focus of our business. We do a little bit of construction and remodel finance. I would say that's kind of on a one-off basis, and focused really on an owner builder of a home that wants to do something kind of custom or semi-custom, or somebody that wants to do a large remodel or expansion or renovation of a home.
Well, here's a question I got for you after the call that we had before. Is there any trends that you can speak to with your commercial side that you're seeing as it relates to the residential lending side, right? They both affect each other, right? Specifically with the high demand that we're seeing right now.
Mm-hmm. Yeah, they do. So we're seeing this weird kind of supply and demand side issues relative to inflation. And one of the more interesting points that we're seeing is, one, home builders are getting savvier about, and I don't know if we spoke about this much, Richard, but it came to mind as I was thinking more about our conversation. Home builders are getting savvier about contracts. And so, where when we first started seeing some of the materials price increases, they didn't have a mechanism to pass that on to the buyer of the home. So they would have to eat that, and that would carve into their profits, but a home buyer could get there. Now that they're wiser about it, we're seeing where we had qualifications for a mortgage amount that worked for a borrower, an escalation provision in a contract because a garage door went up in cost, or because appliances went up in cost, or something like that, is creating some issues there.
Interesting.
So that is, and we're in this market, it's very unfortunate for the borrowers, right? You feel terrible that these people have gotten this far along and then can't qualify for a bigger mortgage or bring more cash into it. But it's protecting profits for the builders, which is good for them. I will say overall that we've seen some mitigation in some of the raw materials prices. I think lumber has normalized a little bit. Trade labor continues to rise in costs. We're seeing that, but the real area that we're seeing issues relative to supply chain is in equipment, like garage door openers, and then specifically appliances. And so the interesting thing about that is when we think about all the issues that are driving some of these challenges, I think the thing that gets overlooked a lot is the issues that come into the infrastructure and how we bring products from overseas into the U.S. Our port system is older and frankly somewhat antiquated. It's very much reliant on human labor, where we've seen significant efforts to automate in places like Asia and use machines to be able to do that work. And so our ability to bring sufficient containers through those facilities, was really stressed in COVID when we had people unable to work and people sick and quarantined and those sorts of things, and really called out the need to bring more automation to that and increase the capacity there for those ports to be able to move product. and move into a more digital age. But there's a significant stranglehold on those ports from the labor unions, which really has hindered our ability to do that, or the industry's ability to do that, to be able to improve the efficiency in the supply chain. So I think we're really a long ways from being able to see an effective supply chain that can handle the needs that we have for the continued increase in housing demand, which has been tempered for a long time. But I don't see anything that's anywhere near many, many years of continued large growth in the housing industry in the United States overall.
Well, I thought that was really interesting when you were telling me that appliances were actually the holdup right now and getting them off the ships and into the ports. See, from everything I've been reading and everything I've heard, I thought it was, lumber. That's what everybody's been reading, right? Lumber and building supplies actually building the homes, but that's not affecting at least the properties for the most part, right? That you're building.
From a timing perspective, we haven't had labor shortages per se. We've seen budgets that became stressed because labor got very expensive and it's normalized a little bit. And then, other inputs, more on the commercial side, when we look at steel got very, very expensive. And a lot of those things too, really came down to creating issues for contractors and their costs when they had contracts that were based on the old prices. But certainly here, I'm in Arizona and we have a significant growth. We expect 50,000 new households in Phoenix this year. Finding labor to be able to work on these projects is a tremendous issue. But I would say from the standpoint of getting building supplies, we don't have as big of an issue as other areas. I do know, I've read a bit that as you kind of move further away from the coasts, and further away from the supply chains, when we have a limitation on those products, we're very close to the Long Beach and LA ports. So, we're kind of a close point. It's the guys that are further down the chain where, from a seller's perspective, why would I pay to ship it to Albuquerque if I can just ship it to Phoenix and sell the product? So I do think there's some weird things, things that guys like you and I don't think about these industries and about the supply chain that would never cross our mind that maybe impact us different ways than it would in a market that was kind of more inland.
Yeah, for sure. I mean, when you first brought up appliances, I thought you were talking about the computer chips in the appliances, because everybody hears about that and the production issues. I know cars are being held up. If you go to car dealerships across the country and try and lease, there are no lease incentives right now. You are actually paying the same amount to lease a car that you are to finance a car in most car dealerships because they just don't have inventory. There's literally nothing on the lot.
Well, they've had a good friend of mine, just an anecdote on that, was looking for a new Toyota Tundra, and the dealer close to his house had one that was equipped the way he wanted it in stock, and they were trying to charge him a $10,000 low stock premium on the vehicle. And so, needless to say, wasn't excited about paying that. Went and found a dealer that wouldn't. But it's created a big disruption. And on that front, I'm no expert in the semiconductor industry or the microchip industry for that matter. But there doesn't seem to be anything on the horizon where we're going to see a real correction of that anytime soon.
Yeah, for sure. Well, really interesting. It's interesting that the appliances are really tied to the, to the actual shipping and loading and those kind of just very basic stuff, right? That you wouldn't think would be the holdup. Does it actually hold up a home, right? Like you got a new home done. I mean, you can't sell the home without a fridge or a dishwasher, right?
No, you can't. And a lot of this comes down to good management from the builder's perspective. It's not that they can't be had. It's just a question of timing being different than what it would have been, a year ago or 3 years ago, right? So we have seen some instances where I would say there were kind of modest delays where they weren't there, but I've been generally impressed with the home builders that we work with on their ability to get out and say, okay, I know, and this is in commercial construction too, I know I'm going to have to get certain things ordered ahead of time. Commercially, a big one right now is doors. So you've got to get out ahead of doors or you're not going to have doors in your building. So I think what it's creating is a requirement that builders be more proactive in ordering their supplies. I don't believe there's anything that we kind of quote unquote can't get. But if you're not on top of getting that stuff ordered early, it's going to catch you and mess with your schedule for sure.
Well, so let's pivot here. I know that a lot of cities and markets in the country right now are having a lot of trouble because there's just not enough residential homes for people who want to buy the homes. And actually, a lot of investors are coming in, like Dallas, from what I understand, used to be 4% investor owned with the residential homes now, and now it's like over 20% or 25%. And so my Two-part question. One is, are you seeing that in your Arizona and New Mexico kind of areas, and is it also good for your business because you guys do a lot of commercial loans?
So we are seeing a tremendous amount of investor interest in the market, and from the same groups that I think you look at Dallas and Atlanta, and there's a lot of hedge fund money that's coming in there, and that doesn't really do a whole lot for us. I mean, those guys are writing big checks, and they're definitely kind of propping up the market, which otherwise would be very very active anyway because of the we continue to have big in migration. So and a lot of that's a product of the fact that we were really underbuilt for a lot of years because a lot of home builders really got burned in the kind of 2008 to 12 timeframe, and we're a little hesitant to really ramp up production volumes. So now that we're seeing that dissipate, I don't know that it's really good for anybody's interest when we start talking about kind of smaller businesses to have these private equity funds own billions of dollars of real estate in the markets. I still like to see that we're supporting home builders that build homes that people want to own and live in. I don't know that does a lot for our economy to get a lot of rents pushed out to a company like BlackRock. We do have a lot of kind of individual local investors that are doing that kind of work, and we love supporting those guys. But I think the ramifications of it, beyond just money kind of leaving our markets, which is important for us as a local institution, is housing affordability is getting worse and worse when we talk about Phoenix in particular. When you start having not only the kind of workforce housing priced out, people that work in service industries and businesses all over town, it's harder and harder for them to find housing. And even you have young professionals. We have people that work for us that are out of school and trying to buy their first home and are priced out of the market in a big way. And so I think it creates a lot of challenges for us. And certainly it's a healthy economy, and it's great that people are investing in it, but it's not without its risks.
So, I mean, a lot of folks don't like answering this question, but do you think there should be some government regulation? I mean, the only reason I bring that up is Canada just literally came out. I think Justin Trudeau was just straight up saying no more foreign investment in the Vancouver market. It's too hot. So for 2 years, there's a moratorium on foreign investors buying any property in Vancouver. That's pretty extreme.
It is. It's hard for me to say I'm a fan of government regulation because of the adverse consequences are really hard to get at. Vancouver is an interesting market. This goes back, probably to 2012 or 13 or somewhere thereabouts. But a number of years ago, that's always been a kind of a darling for Chinese investors. And
Yep.
Somebody made a website called mansionorcrackshack.com and highlighted $1 million homes, in Vancouver with crack houses that they found in some kind of a database, and you had to pick whether this was $1 million house in Vancouver or a crack house. And so I do think some kind of market or some sort of intervention could help, but I'm always hesitant to want to see the government more involved in these things than they need to be.
Yeah. Well, let me ask you a question. So rates are rising. We're in a rate rising market right now, and it's going to continue. It's a good thing or a bad thing? Is it different? Is that different for commercial versus residential in your mind?
No, I think it's very much the same. So banks look at rising rates as an increase in profits, right? A lot of the money we make is based on interest margins, and historically, generally speaking, you have rates on loans increase faster than banks rise rates on deposits. So it should make the banking business more profitable. I think it comes with a lot of economic risk, right? When we look at both residential and commercial, the value of assets and how much people pay for them is predicated on interest rates. When we look at mortgages, most mortgages are bought based on a monthly payment at an interest rate. And so, if you look at the history of the increase in housing values from the 80s to today, more than half of it can be explained in reductions in interest rates. So yeah, I think it's a problem. I think you're going to have people's affordability continue to decline as market interest rates rise. I will say the longer end of the rate curve has been pretty steady, so I don't know how much that's going to translate into continued increases in residential mortgage rates. But I don't think that's a good thing. And when we look at commercial property, the value of a commercial property is how much income it produces and what the rate of return is. And so those rates of return have to go up, which means values have to come down. And so overall, there's a reason that the interest rates are such a powerful policy tool for the Fed, and that's because they impact our economy tremendously. And so, if interest rates get back up over 5% or 6%, that has to adversely affect the economy because we're just so dependent on housing to drive so much of what we do. So I think it's a big risk that I think while inflation is a tremendous problem, we're in a bit of a bind here. It's a weird thing to think about economic risks being high and how do you, as an investor in anything, how do you invest? But you don't want to stay in cash because inflation's 8%. So it's a weird predicament that we're in right now for sure.
Yeah, for sure. Well, so you guys did really well. Your specific organization did really well last year, as I remember you were saying. And then this year, I believe you were forecasting like a 20% growth or something like that. So you're both growing and you're getting more profitable at the same time. So is that just a beautiful thing right now for your organization? And do you think most banks are kind of looking at it this similar, or you guys are unique?
So we had a great growth year last year, looking to have another good growth year this year. We happen to be in a market that is growing tremendously from a local economic perspective, right? So there's a lot of opportunities for us to grow. Interest rates are rising, which generally should be good for banks, but recession risk is high. So, we're trying to continue to build our business intelligently and grow the right way and be wise about how we go, but be mindful of the fact that, the kind of rate rises specifically that we're talking about from the Fed. The last time the Fed raised rates, it basically almost immediately caused, a lot of people would say, the dot-com bubble. So, when you have really high equity valuations and the Fed starts aggressively attacking rates and a lot of people saying that the market needs to come down a lot, those things create issues. One of the most powerful things, I really try to frame economics as a social science. When people see the value of their 401k go down, their brokerage accounts go down, they spend less money because they feel like they have less money. Like, those are powerful drivers of human behavior. And at the end of the day, the economy comes down to somebody's confidence in going and spending a dollar. And so, there's certainly is a lot of risk in those things, but we think local microeconomic conditions are still going to be good as we continue to have people want to live here. The big urban centers continue to kind of drive people away. Employers are more receptive to having people work remote. So we feel good about the economy here, and that's part of it, and a real effort to kind of grow our business in a market where the competitive landscape is conducive to what we want to do.
Well, Michael, that was a huge lesson. I feel like I was in an economics class for a second. That was fantastic. Look, I appreciate you giving us your time. I just want to say that if anybody wants to reach out to you, is there a good way that they can reach out to you? Is do you prefer email? You prefer LinkedIn? Sure. Anything like that? Yeah,
LinkedIn is great. If anybody has any questions for me, they can email me. It's pretty simple. michael.s@bank34.com. A friend of Richard's is a friend of mine, so they can reach out to me there, and I'm happy to answer anything I can.
Awesome. Michael, well, thanks so much for a great discussion.
Yeah, it's always a pleasure, Richard. We'll talk soon.
Thanks for listening. If you like the podcast, please give us a 5-star rating, subscribe, and tell all your friends about the show. We at Sales Boomerang started this podcast to elevate the mortgage lending industry by sharing the kind of exclusive, insider knowledge from the successes and failures of the best of the best. The foundation of every successful lender is borrower retention. Sales Boomerang is the #1 fully automated borrower retention system in the industry. 1 in 2 of the biggest lending companies in the United States use Sales Boomerang to make sure they reach out to their borrowers when they need a loan, and more importantly, before their competitors do. If you want to learn more about Sales Boomerang, check us out at salesboomerang.com.